Ever wondered how companies account for their short-term investments or long-term bonds? In this video, we're breaking down passive investments in financial assets under both IFRS 9 and ASPE 3856. By the end, you'll know exactly how to classify, measure, and report these investments, and you'll easily handle exam questions or real-world transactions. Before we dive in, don't forget to like this video, subscribe to Canada Accounting Insights, and hit that bell so you never miss a future accounting deep dive. Let's start with the basics. Passive investments are financial assets purchased mainly to earn returns, interest, dividends, or capital gains, rather than to exercise control or significant influence over another entity. Think of things like bonds, term deposits, or shares held purely for income, not for strategic control. IFRS 9 defines a financial asset as anything that gives the holder a right to receive cash or another financial asset. For example, cash itself, equity instruments of another company, accounts receivable, or derivatives that are in the money. But remember, physical assets like inventory or PPE and intangibles like patents aren't financial assets because they don't represent a right to receive cash. Now that we know what passive investments are, let's move into how IFRS actually classifies them. Under IFRS 9, passive investments are classified based on two main factors: A, the company's business model for managing the asset, and the contractual cash flow characteristics. These two tests determine which of the three categories the investment falls under: fair value through profit or loss, or FVPL, amortized cost, or fair value through other comprehensive income, or FVOCI. Let's walk through each of them. We'll begin with FVPL, the default category. This applies to investments that don't meet the criteria for the other two categories. Typical examples include investments held for trading, or assets designated as FVPL to avoid accounting mismatches. All gains and losses go straight to profit or loss every reporting period. Next, we have amortized cost. Debt instruments qualify here if two conditions are met. 1. The business model is to hold and collect contractual cash flows, and 2. Those cash flows represent only principal and interest. Examples include bonds held to maturity, term deposits, and accounts receivable. These are measured using the effective interest method, which we'll explore in a moment. Finally, we have FVOCI. This category applies when the company both collects cash flows and sells the investment if market conditions are favorable. For debt instruments, unrealized gains and losses go to OCI, and when sold, they're recycled to profit or loss. For equity investments, the entity can make an irrevocable election to classify them as FVOCI, but once chosen, unrealized gains and losses stay permanently in OCI. So, those are the three IFRS buckets. But how do we record these investments in the first place? Let's move on to initial measurement. When an entity acquires an investment, it recognizes it at fair value, basically the amount it would pay in a normal market transaction. But there's also the question of transaction costs, and these are treated differently depending on the classification. For FVPL, transaction costs are expensed immediately. For amortized cost and FVOCI, the costs are capitalized as part of the investment. Here's a quick example. If a company buys 300,000 shares at $5 each and pays $25,000 in fees, under FVPL, record a $1.5 million investment and expense $25,000. Under FVOCI, record a $1.525 million investment, fees included in cost. Once the asset is on the books, the next question is, how do we measure it over time? Let's break that down next. Subsequent measurement depends entirely on the category. Let's go through each one briefly. For fair value profit and loss investments, at each reporting date, you remeasure the investment to fair value, and all gains or losses go directly to profit or loss. Dividends are recorded when declared, and interest is based on the stated rate. For amortized cost investments, for investments at amortized cost, we use the effective interest method. This spreads interest income, premiums, or discounts evenly over the life of the asset. If the investment was purchased at a discount, interest income increases over time. If purchased at a premium, it decreases. The goal is to ensure the carrying amount equals the face value at maturity. For fair value other comprehensive income investments. For FVOCI assets, we still update to fair value, but the unrealized gains and losses go to OCI, not profit or loss. For debt instruments, interest revenue is calculated using the effective interest rate. For equity instruments, only dividends are recognized in profit or loss. So far, we've looked at how to recognize and measure passive investments. But what happens when an investment's value drops? Let's talk about impairment. Impairment applies only to debt instruments measured at amortized cost or fair value through other comprehensive income. Under IFRS 9, entities must recognize an allowance for expected credit losses, or ECLs, whenever credit risk increases. For FVPL investments, no separate impairment is needed. The fair value already reflects the loss. For amortized cost, compare the carrying amount with the present value of expected future cash flows, discounted at the original effective rate. For FVOCI debt, losses go to profit or loss. For FVOCI equity, impairment stays within OCI. Now that we've dealt with impairment, let's shift gears to what happens when an entity changes its business model. Reclassification. Reclassifications don't happen often, only when the company's business model for managing its financial assets fundamentally changes. And that's key. It must be a genuine shift, not a temporary one. These changes affect only debt instruments because FVOCI designations for equity are irrevocable. Here's the summary. Moving AC to FVOCI means recognizing the difference in OCI. From AC to FVPL means recognizing the difference in profit or loss. And from FVOCI to AC means remeasuring at fair value and adjusting cumulative OCI. All reclassifications are prospective, meaning the new measurement applies going forward only. Once reclassification is done, the next step in the investment's life cycle is derecognition, removing it from the books. Derecognition occurs when the company sells or settles the investment. For FVPL assets, the gain or loss is the difference between sale proceeds and carrying amount, recognized in profit or loss. For amortized cost assets, the same idea applies, the difference between book value and proceeds. If the bond matures, there's typically no gain or loss. For FVOCI assets, treatment depends on the type. Debt instruments recycle the cumulative OCI gain or loss into profit or loss. Equity instruments keep the gain in OCI, but you may transfer it to retained earnings. After derecognition, the final step is to ensure proper presentation and disclosure. Let's go over what IFRS requires. Presentation requirements come from IAS 1, IAS 32, and IFRS 7, and they're quite detailed. In the Statement of Comprehensive Income, entities must present interest income, using the effective interest method, gains or losses on derecognition, impairment losses or reversals, gains or losses from reclassifications, and clear separation of OCI between items that will and won't be reclassified to profit or loss later. In the Statement of Financial Position, financial assets are split between current and non-current, based on whether they're expected to be realized within 1 year. And in the notes, disclose carrying amounts for all categories, FVPL, FVOCI, and amortized cost, plus fair value information if it differs from carrying value. Now, IFRS gives us a lot of flexibility, but how does this compare to ASPE? Let's look at that next. Here's where things get simpler. Under ASPE 3856, classification depends on the nature of the instrument, not the company's business model. Let's summarize the main contrasts. In practice, this means ASPE has no other comprehensive income. All gains and losses go straight to net income. Companies can choose either amortized cost or fair value for some instruments, and they can use either effective interest or straight line for amortization, a simpler, more flexible approach. Now that we've seen both sides, IFRS and ASPE, let's tie it all together. Here's the big picture. FVPL, measured at fair value, gains and losses to profit or loss. Amortized cost, effective interest, ECL for impairment. FVOCI, fair value changes go to OCI. Reclassification, rare and prospective. Derecognition, remove when sold or matured. ASPE, simpler, no OCI, and more flexibility in amortization. So whether you're analyzing investments for your CPA exam or working on financial statements, these rules tell you how to measure and report passive investments consistently and accurately. If this helped simplify a tricky topic, drop a like, subscribe, and share this video with a friend preparing for the CPA exam. Thanks for watching, and I'll see you next time on Canada Accounting Insights.